Okay, so let's start this topic. Our topic is valuation of securities. As a company, you may want to value your securities and get the true value of those securities. The true value of a security is what we call the intrinsic value. These securities may include ordinary shares, preference shares, debentures, or bonds. So you, as a company, you have this kind of securities and you want to get their true values. The intrinsic value. Let's start with the first kind of security, and that's the ordinary shares. How do you get the value of ordinary shares? How do you determine the value of ordinary shares? So we want to discuss the different methods of valuing ordinary shares. So let me discuss the methods. Don't write, we shall put down everything later. Okay, so there are three methods of determining the value of ordinary shares. One is what we call the dividend based valuation method. Dividend-based valuation methods. That's number one. Number two approach or way of computing the value of ordinary share is what we call the asset-based valuation method. The asset-based valuation method. Number three is what we call the earnings-based valuation. The earnings-based valuation method. Okay? These are the different ways of valuing ordinary shares. So let me go to the first approach or the first method of computing the value of ordinary shares, and that is the method we are calling the dividend-based valuation. The dividend-based valuation. Let me start with it. Dividend-based valuation. Dividend-based valuation methods. Okay. This approach of valuing ordinary shares, which we are calling the dividend-based, was developed by somebody called Gordon. And according to Gordon, he classified ordinary shares into three categories. Based on their dividend. Gordon classified the ordinary shares into three categories depending on their dividend. Number one is where the first method or the first basis or category, according to Gordon, of the ordinary shares. He classified ordinary shares into three categories according to their dividend, the history of paying their dividend. Okay? So based on the history of paying their dividend, we use the history to compute the value. One is where we have zero dividend growth. Okay? In other words, let me explain, where the dividend of the company does not grow at all. We call it dividend growth. Zero dividend growth rate method. Zero dividend growth method or rate method. Listen, this is where if your company has been paying 2 shillings per share every year as dividend, it will keep paying 2 shillings, 2 shillings, 2 shillings, 2 shillings, 2 shillings. That is what we are calling zero dividend growth. The dividends are not growing. They are remaining 2 every year, 2 shillings every year up to perpetuity. That's one category. The second category of ordinary shares, according to Gordon, is what we call the second category, let me put it down here, is what we call constant dividend growth. Constant dividend growth rate. Constant dividend growth rate. Constant dividend growth rate. Listen, this is where the dividends grow at a constant rate. He classified ordinary again into this second category where dividends grow at a constant rate. For example, the company could be giving you, or the question could give you, that the dividends are growing by 5% every year. Listen, meaning if the first year the company paid a dividend of 10 shillings, or let's say 2 shillings, we expected that dividend to grow by 5% in the next year. So 5%, or let's say 10%, in the following year it will be 2 plus 10% of it. That would mean saying it is 2 times 1.1, 10%. I hope you do remember what we were saying when we were discussing the topic of cost of capital. 1 plus G. 1 D note is 2 plus 1 into G. So this will be 2 into 1.1. Our G is 10%, which is 0.1. So that means in the second year, your dividend will be 2.2. Then in the other year again, 2.2 now will grow by another 10%. Whatever you get there, that will be, whatever it will be, let me just calculate it and see how much it is. That is 2.2 multiplied by 1.1, multiply that by 1.1, that's about 2.42. Then that 2.42 will grow by another 10%. That way. Listen, that is the second category of the dividends according to Gordon, where there is a constant, listen, where there is a constant dividend growth, 10% every year. Every time the dividends keep growing by 10%. Okay? That is the second category of the ordinary shares. Now, number 3 is where we have non-constant dividend growth. Non-constant dividend growth rate method. Listen to this now. Gordon classified again ordinary shares into this third category. Let me explain it, where we are calling it non-constant dividend growth. Now, in this third category, your dividends may grow at a different rate. For example, in year 1, your dividend grew by 5%. After year 1, the dividend grew by 6%. Third year, the dividend grew by 8%, and so on. So in year 1, the dividend will grew by 5%, maybe 6% in the second year, another 8% in the third year, maybe 10% in the fourth year. Listen to this. Then after fourth year, now the dividend will grow at a constant rate. Maybe after the fourth year, now the question tells you, or the dividend will grow by 15% every year into perpetuity. Now, meaning it is the category where we are mixing non-constant with constant. Are you getting? We are mixing non-constant growth rate in dividend and the constant rate of dividend. Okay? Where I've said maybe for the first 4 years, the dividend growth rate keeps changing. But after some time, now we realize that the dividend are growing by a constant rate into perpetuity or into infinity. How do you get the value of such shares? So Gordon classified the shares into these 3 categories. For us to value the shares, you have to know under which category are they falling. Are they falling under zero dividend growth? Are they falling under constant growth rate? Are they falling under non-constant growth rate? I've explained the concept behind the non-constant growth rate, where the dividends are growing in the first few years. They are growing by a non-constant rate. You paid 2 shillings in the first year. It grew by 5%. Whatever you got in the first end 1 year, it grew by 6%. Whatever you got by end of year 2, it grew by 8%. Whatever you got by end of year 3, it grew by 10%. Then whatever you got by end of year 4, now that dividend keeps growing by 15%. Then what you got by end of year 5 will grow by another 15%. What you got by end of year 6 will grow by another 15%. That means after some time, the dividends are growing at a constant growth rate. Now, so to get the value of the ordinary shares now, you have to categorize the ordinary shares into these 3 categories. Let me go to the first category of 0 dividend growth. Of 0 dividend growth. Now, how do you determine the value of shares if they have no growth in dividend? Meaning the company pays 2 shillings, 2 shillings, 2 shillings every year as dividend. Now, to get the formula for computing the value of ordinary shares at 0 growth rate, I want you to recall something we did in the topic of cost of capital. Under cost of capital, we also classified the shares into these 3 categories, into the 2 categories called 0 growth rate. Where we were determining, listen, I am saying recall. When we were determining the cost of ordinary shares, we had to classify the ordinary shares again and ask ourselves, to get the cost of ordinary shares, was there any growth rate in their dividend? Maybe no. To get the cost, which is what we were calling KE, where there was no growth in dividend, we were getting KE by just taking D divided by PO. That was our formula. I have said recall. That was our formula for getting the cost of capital KE. And in that case, the dividend was not growing. The company kept paying 2 shillings, 2 shillings, 2 shillings, 2 shillings. Then we took that 2 shillings, we were dividing by the market price, PO. Okay? To get the cost of the capital in the company. Don't forget we said cost of capital is what? It is the expected return by the providers. I also remember telling you this D divided by P represents what? When you take the dividend, which is the return the shareholder will receive, divide by the price he's paying, how much it's costing him. Let us assume the price is 50 and he gets a dividend of 5 shillings a share. So 5 divided by 50, that is like 10%. So he's expecting a return of 10%. And I told you, whatever the investors are expecting as a return, that is a cost to the company. Are you there? Good. But this time, we are not looking for the cost of capital. We are looking for the price. We are looking for the price. Are you there? To look for the price, now listen, we want to make P the subject. We want to make P the subject. So if I make P the subject, this means I multiply both sides by PO, then I make PO the subject. This will simply be PO is D divided by what? KE. D divided by KE. So this is the formula we shall be using to get the value of the ordinary share where there is no growth in dividend. Are you there? Where there is no growth in dividend. Okay? Good. That was the first category. Now you know how to value ordinary shares where there is no growth in dividend. You take PO equals to D, which is the dividend per share, which is 2 shillings, 2 shillings, 2 shillings every year, divide by the cost of the ordinary shares, divide by the cost. The question will give you the required rate of return or the cost of capital. Good. That is the first formula. Let me go to the second approach of how to compute the compute the value of ordinary shares, compute the value of ordinary shares where there is a constant growth rate. Where there is a constant growth rate. Okay? Where I said the question may tell you the dividends are growing at 10% every year, 10% every year, 10%. What you paid in year one will grow by 10%. What you get in year one, end of year one, will grow by another 10%. What you get as dividend of year two will grow by another 10%. Listen. Again, listen, I want you to recall when we were discussing the topic of cost of capital. Again, we computed the cost of capital where dividends were growing at a constant growth rate. Where dividends were growing at a constant growth rate. And if you recall the formula there, the formula was KE equals to D naught into 1 plus G. We were dividing that by PO plus what? Plus G. You remember that formula? That was the formula for getting the cost of capital where dividends were growing by a constant growth rate. D naught, you remember, we were taking it to be the most recent dividend paid. D naught. G was the growth rate. Okay? P, of course, is the price of the shares. That being the formula, listen to this now. We want to now make the P the subject. So that this time we are not computing the cost of capital KE. I am computing the price or the value of the share. So I want to make P the subject. How do I make P the subject? Of course, you don't need to recall or to do this in the exam, but just for sake of showing how the value of the share formula is derived. So let me now multiply. Listen, no, before I multiply, let me take the G on the right side. I take it to the left side. So if I do that, that will become KE minus G. I've taken G to the other side. Are you there? It will be given by, or will be equals to DO into 1 plus G, DO into 1 plus G divided by what? PO. I have taken G to the other side. Are you there? Good. But now I want to make P the subject. What can I do next? I can now multiply both sides by PO. Are you there? If I multiply both sides by PO, this will be PO equal into PO into KE minus G will be given by, if I multiply both sides by PO, the PO on the right side will go. This will remain with DO into 1 plus G. Of course, you know that calculation. Good. Now I want to make P the subject. I want to make P the subject. So this will be PO equals to D naught into 1 plus G. I divide everything by KE minus G. Are you seeing? I am making PO the subject. What do? I divide both sides. I divide both sides by, maybe I can put it here so that you see it clearly. I divide both sides by the factor KE minus G. So this will be, if I divide both sides, this will be PO into KE minus G. I divide that by KE minus G equals to DO into 1 plus G divided by KE minus G. So I have said, when you take this now on the left, KE minus G will cancel with KE minus G. So that means our formula will be, for getting P naught or P0, our formula will be, let me just rub now this. Let me even rub here now so that you can see that this is PO. This is exactly PO. I hope you are following. This is PO. So the formula we shall be using to get the market price per share or the value per share is D naught into 1 plus G divided by KE. This is KE. This is KE minus G. This is KE minus G. Are you there now? Good. That's the formula we shall be using to get the value of the shares. This is the formula we shall be using to get the value. Of course, listen, in an exam, you don't need to derive this formula. I've just helped you to derive it from the recalling from the recalling of the cost of capital formula, which we did in the topic of cost of capital. Otherwise, you just need to know the formula, getting the value of ordinary shares where there is a constant dividend growth. The value of the share will be given by D naught into 1 plus G divided by KE minus G, where D naught, we are saying it is the dividend, that the most recent dividend, that was paid, the latest dividend that was paid, whatever it is, the dividend that was paid, whatever was the last dividend that was paid. Okay, good. Now, so that being the formula, now before I go to the third one, let me talk to a few of you before I go to the third method of computing the value of ordinary shares, where there is what we are calling non-constant dividend growth rate. Let me talk to some of you. Listen. You may be watching this video, and you have not subscribed to my YouTube channel. Please click that subscription button down there. Click that subscription button down there to subscribe, so that you'll be maybe notified when we post new videos into the YouTube. So if you have not subscribed, click that subscription button below there, that you may get notification whenever we post new videos into YouTube. The other point is, please like my video, click that like button, like this video, click that like button, like the video. I hope by now, at least you have understood something and you have liked what we are doing so far. Click that like button down there to like the video. Good. Now, listen. To everybody else now, if you have friends who are doing this financial management subject, and they have not joined the live class, and they have not joined our online classes, please tell them that we have online classes for financial management of the intermediate level. Also, we have financial reporting of the intermediate level. We also have online classes for financial reporting of the intermediate level, that is FR. We also have online classes for advanced financial reporting of the advanced level, We also have financial accounting of the foundation level and that of ATD1 and ATD2. Those are the 4 subjects in which we have online classes for. That is financial management of the intermediate level, financial reporting of the intermediate, advanced financial reporting of the advanced level, and financial accounting of the foundation level. Okay, so tell your friends who have not joined our classes that we have those online classes. Okay, now listen. If your friends cannot join the live classes, then you can still tell them that they can buy what we call the pre-recorded videos. Where they can watch the videos at their own free time, at their own pace. When they are not able to join the live class, tell them that they can buy the pre-recorded videos and watch them at their own free time for any of these 4 subjects. Okay? Now, they can reach me on this number 0722-658875. So they can text or call that number 0722-658875 to reach me. Okay? That is how to reach me if you are interested in any one of these 4 subjects. Good. So let's now continue. From where we left. Now we want to discuss the third method, or the third category, the third category of dividends according to Gordon. And depending on that third category, how do you compute the value of the shares? We have discussed basis number 1, category number 1, where there is no growth in dividend. How do you get the P naught? It is D divided by KE. Are you there? D divided by KE. That is how to get the value of the share. Number 2, where there is a constant dividend growth. We have said the formula now be, it's PO equals to D naught into 1 plus G divided by KE minus G. D naught, I've said, is the latest dividend or the current dividend paid. G is the growth rate. KE is the cost of capital. You will be given the cost of capital, KE, and G is the growth rate. Good. Now let me go to the third category now. Let me go to the third category. And maybe before I go to the third category, let me also remind you, listen, of those two, of the second category, listen, of the second category, we are saying you will bring in the concept of growth rate. Now, you also remember, listen, you also remember when we were discussing the cost of capital, we saw some topics, some questions were not giving us the growth rate. It was your responsibility to calculate the growth rate. So just as a reminder, how do you calculate the growth rate if the question has not given you the growth rate? I've just been assuming 5%, whatever. So, but remember, in this second category, you need the G. What if G is not given? How do you calculate it? If you may remember, we said there are two methods of calculating the growth rate. There were two methods of calculating the growth rate. One was what? When we were discussing the cost of capital. Even in the valuation of shares, some exam questions don't give you the growth rate. It is again your responsibility to still calculate it. For you to get the value of the shares, the examiner may not give you the growth rate. So it will be your responsibility to calculate the growth rate. How do you calculate it? We said one method of computing the growth rate is what we were calling the compounding method. The compounding method. Whereby we were saying to get the growth rate using this method, I do hope you remember, we were saying it will be the root. It will be, just as a reminder, let me quote it again. This is G equals to n minus 1. N minus 1 is n minus 1 into dn, dn, this is dn. We were dividing that by d naught. Are you there? We are dividing that by d naught minus 1. Whatever you get, we were saying you minus 1. That was our formula for getting the growth rate. If you are using the compounding method, I told you, let me just remind you, n, we were referring it to the number of years. dn, we were referring it to be what? dn, we were taking it to be what? We were taking it to be the last dividend that the company paid, the latest dividend the company paid. D naught, because I told you, for this formula, you will be given the history of how the company has been paying dividend. Let me just use a small illustration here. In year 1, the company paid a dividend of 2 shillings. In year 2, the company paid a dividend of 3. In year 3, the company paid a dividend of 3.5. In year 4, the company paid a dividend of 4 shillings. So those are the years, the dividends that were paid in year 1, or by end of year 1, no, current year 0, whatever, 2, 3, and year 4. No, sorry, let's just even call them 4 years. 1, 2, 3, and 4. 1, 2, 3, and 4. You can even add 5. Year 5, they paid a dividend of, let's say, 5 shillings. Year 5, they paid a dividend of 5 shillings. Now, so N will be what? N will be 5. Are you there? So it will be the root of 5 minus 1. Why were we subtracting 1? Why were we subtracting 1? We were saying you want to know what is the growth rate. If the company paid from year 1 to year 5, they paid 5 dividends. Those dividends grew how many times? We said from year 1 to year 2, that was the first growth. From year 2 to year 3, that was the second growth. From year 3 to year 4, that was the third growth. And from year 4 to year 5, that was the fourth growth. So there are 4 growth. From year 1 to year 5, there are 4 growth, which is what we are saying. It is N minus 1. Good. Then we take our DN. We said it's the latest dividend, which in this case will be what? 5. You divide by the first dividend DO. DO in our case is how much? 2. Then whatever answer you get, we say, whatever answer you get, we said you minus what? You minus 1. That's how you determine the growth rate. So 1 you'll get, it will be like the fourth root of 2.5 minus 1. So you first get the fourth root of 2.5. Then once you get the fourth root of 2.5, you minus 1. That will be giving you the growth rate. That will be giving you the growth rate. Are you there now? Good. That was just one method we talked about on how to compute the growth rate. On how to compute the growth rate. The second method of computing the growth rate, we called it what? What was the second method of computing the growth rate? We were calling it the retention ratio method. The retention ratio method. What was the formula for getting the G using this method? What was the formula for getting G using this method? G we were saying is what? Somebody? G? What was the method? What was the formula? It is R into what? KE. R into KE or BE. No problem. We are calling it KE or BE or KE. No problem. Let's just call it KE. What is important is you need to remember what it means. R was what? R was our retention ratio. Retention ratio. KE was the return on equity. Return on equity. So you have to get what is the retention ratio in the company and what is the return on equity. Retention ratio, I say, some questions may not give it to you, but they tell you something like this, that the earnings per share in the company was 5 and the dividend per share was what? 2. So what was the retention ratio? If the earnings per share is 5 and the company paid out of 5, they paid 2 shillings as dividend per share. So the company must have retained how much per share? 3 shillings. Okay? So 3 out of 5 is what the company retained. So our retention ratio will be 3 divided by 5, which is what? 3 divided by 5 is like 0.6. So our retention ratio is 0.6. I also told you, you can also get the retention ratio by taking 1 minus what? To get the retention ratio, we said you can take 1 minus the payout ratio, dividend payout ratio. Dividend payout ratio. What's a dividend payout ratio? Our dividend per share was 2. Out of 5 earnings, they paid a dividend of 2. 2 divided by 5 that's about 0.4. Okay, as a percentage is 40%, but in terms of decimal, that is 0.4. Sorry, 0.4. So our payout ratio is 0.4. When I take 1 minus 0.4, that leaves me with 0.6, which I told you is the same as taking the earnings, the retained amount of 3 divided by 5. They are retaining 3 shillings divided by 5, which is out of the earnings. That gives me a retention ratio of 0.6. So we said, if the question does not give you the growth, look at the question and find out which of these two methods are we using to determine the growth rate. Are we using the compounding method, compounding growth method, or are we using the retention ratio method? Good. Now, maybe before we go to the third method, let us put down something now on what we have discussed so far. Let's put down something on what we have discussed so far. So let's put down the topic now. Let's put down the topic now. So the topic is valuation of securities. Valuation of securities. So the topic is valuation of securities. Valuation of securities. Valuation of securities. That's the topic. Valuation of securities. That is the topic, valuation of securities. Then below that, you can say methods of valuing ordinary shares. Methods of valuing ordinary shares. Methods of valuing ordinary shares. And put down that subtopic. Methods of valuing ordinary shares. Methods of valuing ordinary shares. Methods of valuing ordinary shares. Number one, dividend-based valuation. Dividend-based valuation. Number two, asset-based valuation. Asset-based valuation. Number three, earnings. Earnings-based valuation. Earnings-based valuation. Then you go to another subheading, dividend-based valuation. Dividend-based valuation. Dividend-based valuation. Dividend-based valuation. Put a dash according to Gordon. According to Gordon. According to Gordon. Dividend-based valuation according to Gordon. Then you say this. Below that, say this. Gordon, we are discussing the first category, dividend-based valuation. Then you say this, according to Gordon, or Gordon, put it this way, Gordon classified ordinary shares into 3 categories. Gordon classified ordinary shares into 3 categories. Gordon classified ordinary shares into 3 categories. Number one, 0 dividend growth rate. Number 1, 0 dividend growth rate. 0 dividend growth rate. Ordinary shares. That is one category of the ordinary shares. 0 dividend growth rate. Put a dash or put something below that. Sema hivi, where dividends do not grow. Where dividends do not grow in the future. Where dividends do not grow in the future. Dividends do not grow in the future. Where dividends do not grow in the future. Number 2, Let's put down something fast before we quote the formulas. Number 2, constant growth rate. Constant growth rate, ordinary shares. Constant growth rate, ordinary shares. That was the second category of ordinary. Constant growth rate, ordinary shares. Constant growth rate, ordinary shares. Put something there. Where, put down something there, where dividends grow, where dividends grow at a constant, where dividend grow at a constant rate in the future, where the dividends grow at a constant rate in the future, where dividends grow at a constant rate in the future, where dividends grow at a constant rate in the future. Number 3, another third category, non-constant dividend growth. Non-constant dividend growth rate, ordinary shares. Non-constant dividend growth rate, ordinary shares. Non-constant ordinary growth dividend. Let me explain. I don't know whether I explained it earlier. Let me just explain it. I can remember I explained the first two, but I don't know whether I explained the last one. I don't know. Let me see whether I explained it. I just mentioned it. Did we explain it? Good. Yes, I explained it. Where I was saying, let me first explain it. Where I was saying the dividends grow at different rate in the earlier years. Okay? They grow at a different rate in the earlier years, then at a constant rate, into perpetuity. Good. Maybe we can put down that information now. Number 3, I've said number 3, non-constant dividend growth ordinary shares. Sema hivi, where dividends will grow, at different rates, during the earlier years, where dividends will grow at different rates during the earlier years, before the growth rate becomes constant, until infinity. Before the growth rate becomes constant until infinity. Good. Until infinity. Okay? Let's now go back to each of those now to discuss how to use them to compute the cost. Let's now start with number 1, 0 dividend growth. 0 dividend growth rate. How do you use it to compute the value of the shares? How do we use it to compute the value of the shares? This time I'm not going to ask you to recall. I'm just going to quote the formula direct. PO equals to D divided by KE. Okay? Just put down that formula, that to get the value is D divided by KE. E divided by KE. Then you say this, where D is this way, where D is dividend per share, and KE is the cost of ordinary shares. Cost of ordinary shares stroke equity. Cost of ordinary shares stroke equity. Cost of ordinary shares stroke equity. Then you say this below that. Say this below that. In this approach, the dividends remain constant. The dividends remain constant into perpetuity. The dividends remain constant into perpetuity. Dividends remain constant into perpetuity. Dividends remain constant into perpetuity. Good. That's number one. Number two, constant growth rate. Ordinary shares. How do we get their value? Where we have a constant dividend growth rate, ordinary shares. How do you get their value? So this, again, I'm not asking you to recall the cost of capital for this category. Remember, I'm using the recall of the cost to derive the formula. But now you can just quote the formula. PO equals to D naught into 1 plus G. Divide that by KE minus G. Quote that formula now. Quote that formula. Quote that formula. Quote that formula. Then below that you can say where DO is last dividend, the last dividend that was paid. DO is the last dividend. Okay. G is growth rate. G is growth rate. KE is cost of equity. Cost of equity. I also want you to recall, just to explain, you recall that DO into 1 plus G is the same as D1. What was D1? If you remember, D1 is what we were saying is the expected dividend. Expected dividend. Expected next dividend. We can put it that way. Expected next dividend. Expected next dividend. What is the next dividend that is expected? Good. So which is in other words to say, listen, which is in other words to say, your numerator DO into 1 plus G can become D1. The same concept we talked about when we were talking about the cost of capital as a topic. Then below that, I want you to say this. Below that, I want you to say this. NB. Note. Note. Where the growth rate is not given, where the growth rate is not given, where the growth rate is not given, it can be calculated. It can be calculated using either of the following methods. It can be calculated using either of the following methods. Where the growth rate is not given, it can be calculated using any of the following methods. Either using either of the following methods. 1, compounding method. Compounding method, where we come and say G equals to root n minus 1 into dn divided by d naught, dn divided by d naught, everything minus 1, everything minus 1. Where we were saying, where d naught or dn, sorry, is current dividend, d naught is past stroke first dividend, d naught is past stroke past dividend, the d1 or dn is the current, the latest. Okay, n number of years, and n minus 1 is the number of growth period, periods, number of growth periods, Good. That is n minus 1, so that you get the number of growth. Okay, that is formula 1 if you are not given the growth rate. Let's quote number 2, the formula for getting growth rate if it's not given. Number 2, that is retention ratio method. Retention ratio method, where we say to get G, it's R, multiply that by KE. R, where R, we said, is the retention ratio, where R is the retention ratio, or 1 minus dividend payout ratio, or 1 minus dividend payout ratio, 1 minus dividend payout ratio, that is R. So if you are determining R, which is the retention ratio, you can take 1 minus the payout ratio. The question might tell you the payout ratio was 10%, 40%. So if you know the payout ratio is 40%, you minus 1 from 0.4, you get the retention ratio. Then we can say KE is equals to return on equity. Return on equity. Return on equity. Which of course in short we can write as ROE. Return on equity. So those are the two methods. Let's go to put down the third method now. We have mixed A and B, blah, blah, blah. Now listen so that we don't mix them again. Listen so that we don't mix them again. Where we have said methods of determining growth rate, the compounding one, make it A. Don't forget we have 3 methods of computing the price. The zero growth rate, the constant growth rate, and the non-constant. So we are labeling them 1, 2, 3. But now I said where the growth rate is not given, you compute using any of the following methods. You label the compounding method as number A. That is compounding method. Retention method, now label it as B so that you don't mix the 1 and 2s. Good. Now we can go to the third method now of getting the value of the shares. Let's go to the third method now. And you call it non-constant dividend growth. Non-constant dividend growth rate, ordinary shares. That is the third category of ordinary shares. Those the category of ordinary shares. To finish, I talk about how to determine the value. I told you how to do it. It is where the dividends are not constant in the earlier years, but at a constant rate in the later years. Maybe you can put it this way. Put it this way. Put it this way now. Under this, you say where dividends increase. Where dividends increase at different rates in the earlier years. Where dividends increase at different rates in the earlier years. Where dividends increase at different rates in the earlier years. And at a constant rate. And at a constant rate until infinity. Until infinity. And at a constant rate until infinity. Until infinity. Then you can say this below that. Now how do you get the value? You get the value of those shares. We can say P0 equals to, this is value, present value. Let me first write it. Present value of dividends during the non-constant period. During the non-constant period. During the non-constant period. Plus present value of dividends, present value of dividends during, let me put it, this is present value of dividends during, present value of the dividends during the constant period. During the constant period. Listen to this now. This is where now we say you don't have to write this, but just to remind you, this is the same as D naught into 1 plus G divided by KE minus G. Remember the second formula where we had a constant, so you get the value that way. We shall, of course, do an example later. But that's the way you get the present value of the dividends. Let me explain. Listen. So I told you year 1 dividend was 5. Year 2, it grew by 5%, came to whatever. Year 3, it grew by 7%. Year 4, it grew by 8%, and so on. For the first 5 years, it was growing at a different rate. Get the present values of those dividends. Get the present value of dividend of year 1. Get the present value of dividend of year 2. Get the present value of dividend year 3. Get the present value of dividend of year 4. Get the present value of dividend of year 5. Then after 5 years, now the dividends are growing at a constant rate. So you get it by using the formula for the constant. By using the formula for the constant dividend, where it is D naught into 1 plus G minus, divided by K E minus G. Okay? Good. Finish. I want us to do a few now past paper questions. I want us to do a few past paper questions on what we have said so far on valuation of ordinary. Before I talk about the second method, which is the asset-based, let's discuss the dividend-based, which I've given you the 3 categories. But we want to apply those methods, whichever it is, by the question. to determine the value of ordinary shares. Let me project a question so that we do 1 or 2 questions on that subtopic. Allow me to project a question now. Allow me to project a question. Allow me to project a question so that we do. I hope you are through with the copying. Now I can project a question. So that's the first question I want us to do. It's a question that came in November 2018. November 2018, question number 2C. November 2018, question number 2C. That's the one I want us to do first. November 2018, question number 2C. Let me read it. It says the earnings per share and the dividend per share for Maraba Limited over the last 5 years are provided below. So you are given a column of the dividend per share, you are given a column of the earnings per share, and the number of years. Additional information. Number 1, a prospective investor is considering buying this company, which are currently selling at 55 each at the Securities Exchange. The investor's required rate of return is 20%. Okay? Required. Advise the investor on whether to buy the shares of Maraba Limited using the Gordon's model. Of course, you can see, listen, you are given the dividends of year 1, year 2, year 3, year 4, year 5. Which means, and I can see they are growing. So this means there is a growth in dividend. So it is obvious I am not using the first one of 0 growth. No. Why? Because I can see the dividends are growing. 2, I can see they are growing from 1 to 5. After that, there is nothing. We are told they are growing at a constant growth rate. So it is obvious this question wants you to use the second category of the dividend, where the dividends are growing at a constant rate. They are growing at a constant rate. Let's do the calculation now. Let's do that calculation. We are trying to do this question of November 2018. November 2018, question 2. I think I've said C. Yes, question 2C. I've told you, according to this question, I can see the dividends are growing. So we are going to use the formula PO equals to DO into 1 plus G, divide that by KE minus G. That's our formula. Let's see what we have not been given. Let's see what have we not been given. We know DO, it is the latest dividend. DO is the latest or the current dividend. That one I know it. What have we been giving us? How much is the current dividend as per the question? If you look at the column for dividend, the current one is 1.8. Don't forget we are doing 2019, 2017 calculations. But they have given us the history in the past. 2017, they paid a dividend of 1.8. That is DN. Okay? Good. That being the DN, what else don't we know? We don't know the growth rate. KE, do we know the cost? Let's go and check. Do we know the cost of capital? Yes. Number 2 says, note number 2 says that the investor's required rate of return is 20%. That, of course, represents the KE. Good. So we are calculating. The only thing we don't know here is the growth rate. Let's compute the growth rate. Now, using which method? Of course, we are using the method called compounding because there is nowhere we have been given the retention approach. No. Let's compute G. G, we are saying, is given by the nth root. We are calculating G. We said is the root n minus 1 into root dn minus divided by do minus 1. Let's quote the let's now feed in the data. We are calculating the growth rate now. We are calculating the growth rate. You can even say their determination of growth rate. Determination of growth rate, so that you remember what are we calculating. We are calculating the growth rate. So our DN, we said, is the current dividend. What is the latest dividend? So G equals to our N. Remember, there were 5 years. You remember? Then I take 5 minus 1. 5 minus 1. Our DN was 1.8, the last one. Let me go and pick the first dividend. DO is the first dividend. I can see DO down there at the column of the dividend. The first dividend was 1. So that becomes 1. DO, that is 1. Whatever I get, I minus 1. Whatever I get, I minus 1. So this will be, G is the fourth root of what? What is Dn? Any number divided by 1 is the same number. 1.8 minus 1. Let me get the fourth root of. That is 1.8. The fourth root of 1.8. If I'm correct, I'm getting something like 1.158, 1.583. If I now minus 1, that looks like 0.1583. If I express it as a percentage, that will be 15.83%. 15.83%. That is the growth rate. Now we can use it to determine. The price. Now we can use it to determine the price. Finish copying if you are still copying. Now we can use it to determine the price. So let's calculate the PO, which I've said is DO into 1 plus G divided by KE minus G. So what is D? D is 1.8 into 1 plus 0.1583 decimal point. You divide that by KE. We were given cost of capital, cost of equity, cost of capital to be 0.2, which is 20%. 0.2, which is 20%. I minus G, 0.1583. Good. Let me multiply the numerator. This will be 1.8 times 1.1583. You minus, or you divide that by what? What is 2 minus 1583? That becomes the denominator of 1.8417. Let me get the final answer now. This will be 1.8 times 1583. The numerator I'm getting there is 2.08494. If I divide that by 1.8417, what does it come to? Let me take this. I divide that by 1.8. Just a minute. My denominator is wrong. I took 2 instead of 0.2. Sorry for that. My denominator is wrong. Let me repeat it. My denominator is wrong. I took 2 minus instead of 0.2. So let me take it again. 0.2 minus 0.1583. Please make that correction. It should be 0 point, not 1 point. 0.0417. Sorry. 0.0. Let me wrap this again. This should be 0.0417. The numerator is, I think, okay. The denominator was the one which was a problem. So let me now take the numerator, 2.08494. I divide that by 0.0417. I'm getting 49.99. So let's make it 50. That is to the nearest whole number, 50. Now that is the price. Okay? Don't forget, they're asking you to advise the company or the investor. Let's go back and see what advice are they asking we give. Now that we know the true value of the share is 50. That is what I said is also called the intrinsic value. Let's go back and now check what are they selling it in the market, so that we advise the investor whether he should buy this share or not buy this share. Okay? So let's go back and check what the question is giving us. The question said, under note number 1, the prospective buyer is considering buying the shares of this company, which are currently selling at 55. Now my question is this: if the shares are going at 55, that's what they are being sold in the market, and you are an investor, and you have computed that the true value, the intrinsic value of the share is 50, will you buy the share? Will you buy the share? The true value, according to your calculation, that share should be worth 50. But in the market, it's being sold at 55 currently. So as an investor, will you go and buy the share? Obviously, you will not, because you think the share is overvalued. They are currently selling it at 55, while it should be sold at 50, the true value. So the share is overvalued, and therefore you should not buy the share. So maybe you can put down the conclusion, and the cappuccino conclusion. Conclusion, say this. Conclusion, then you say this. The share is overvalued. The share is overvalued. Overvalued. Since the intrinsic since the intrinsic true value is shillings 50. Is shillings 50. Is shillings 50. But the current market price is 55. Is 55. Is 55. Therefore, the investor should not buy. Underline not buy. The investor should not buy the share. The investor should not buy the share. The investor should not buy the share. Good. Let's do another one. That was question number 2 of 2018. Let's now do another question. Let me project another one. We are through with that question. You can see it was a good question. You got how many marks? You got 8 marks for just advising the company not, or the investor not to buy. Good. Let me project another question now. We want to use the second question to get the value of the share. Then again, you will be required either to advise by the investor or not to buy the. Let's go to 2021. Another question. Let me project it. Let me project another question. Let me project another question now. Okay. Let me project another one. Good. There it is. That question 1, C2. Question C2 is a question that came in May 2021. Question 1, C2. That's the one I want us to do. Question 1, C2. I want to read it. Question 1. It was question number 1C, Roman 2. It says, Hazi expects to pay dividend of 5.4 per share in 1 year's time. Hope you are getting there. Expects, not that they have paid, expects to pay a dividend. They expect to pay a dividend of 5.4 per share in the next 1 year. Additional, the company's dividend payout is 60%. The shareholders' required rate of return, the shareholders' required rate of return on equity is 15%. 3. Dividend have been growing at a constant rate into perpetuity. Number 4. The company's share are currently trading at 64.5 per share in the Securities Exchange. Required. Advise the investor who holds shares in this company whether to buy more or to sell the shares. Good. So again, here is a question where we want to value the ordinary shares based on which method? Again, this is a constant dividend. Remember, note number 3 says dividends have been growing at a constant rate into perpetuity. So again, this formula or this question wants us to use the second approach. Let's do the question now. So I'm saying we are now doing May 2021. May 2021, question 1C, Roman 2. Question 1C, Roman 2. Let's first quote the formula. PO equals to DO into 1 plus G. Divide that by KE minus G. That's our formula. That's our formula. Then I want you to listen now. Listen. DO, I told you, is the last dividend. Listen carefully. DO, I told you, is the last dividend. But if you remember us reading this question, they said the company expects to pay a dividend of 5.1 in the next. Let me take you back. The question. Look at the start of the question. Romans 2. It says, Hazi Limited expects to pay, not that they have paid, expects to pay a dividend of 5.4 in the next or in 1 year's time. Listen, I told you, even when we are doing the topic of cost of capital, that sometimes the examiner gives you the last dividend paid, that is the recent, or sometimes he does not give you the recent dividend paid, but he gives you the expected dividend. So how you will use this formula, listen, how will you use this formula depends. The last question we did, we were given the history of the payments of dividend. This question does not give me the history of the payments, but it gives me the expected dividend 1 year from now. I told you, if you take D O into 1 plus G, what are you getting? D being the current date dividend, if you multiply by 1 plus G, that gives you, 1 plus G gives you the way they expect the dividend to grow. So we said DO into 1 plus G ideally represents D1. Listen, so I told you, depending on the way the examiner has given you the question, you will either use D1 or you will either use D note. Are you saying? D note is where they give you the history of the dividend, meaning you can pick the last one. But DO into 1 plus G is always the same as D1, the expected dividend. So from this question, they gave us the expected dividend. So we can convert this formula to B now, where we can say, note, maybe you can copy the formula, note, D1 equals to D naught into 1 plus G. Just to remind you that D1 equals to D naught plus G. Okay? Now we are saying, note again, we are given, andika somewhere, we are given the expected dividend. The expected dividend. So this means P naught, it will be given by D1 divided by KE minus G. So I'm just converting the numerator into D1 because this time I don't know the history of the payment, but I know the expected dividend. That's important to remember. We can see it is even tested in this topic of valuation. We applied the concept when we were discussing the topic of cost of capital. Yeah? Good. Now we can only calculate. Listen now. The only thing we don't know from here is the G. Go back. You go back to the question. We don't know the G. They have not given us. They are saying it is just growing at a constant growth rate into perpetuity. So I want you to look at this question and then ask yourself again, now that I don't know the growth rate, which of the two methods of computing the growth rate can I use? Which of the two methods of computing the growth rate can I use? Am I using the compounding growth rate, compounding method, or am I using the retention? If you look at number 1, we are given the dividend payout 60%. Okay? We are given the dividend payout. Then number 2, we are given the return on equity is 15%. Are you seeing it there? The return on equity is 15%. So obvious, this question wants you to use now the second method of computing the growth rate. Sawa. Good. Let's come and say a G, andika now. G is given by retention, or maybe you can put it this way. G is equals to R by KE. R by KE, where R is the retention ratio, which I told you is also 1 minus what? Minus payout ratio. 1 minus dividend payout ratio. 1 minus dividend payout ratio. Payout ratio. Then KE is return on equity. Return on equity. We know the figures now. We know the figures. So copy that. We come and then say here R, our retention ratio. I want to take 1 minus the payout ratio. We were given the payout ratio in this question, and we were told it was it 60 or 40? Let's go back and check what was the retention ratio. No, the payout ratio. Good. Note number 1 told us that the company paid dividends at a payout ratio of 60%. Good. Note number 1 tells me the payout ratio is 60%. So I take 1 minus 0.6. This will be 0.4. So now we know the retention ratio. Now we can compute the growth. We have been given the return on equity as 15%. Come and see your growth rate equals to 0.4 times the return on equity. Our return on equity were given as 15%, which is 0.15, So what becomes our G? 0.4 times 0.15, this looks like 0.06. 0.06. That is the growth rate, which is the same as 6%. Now we can use it to compute the value of the share. We can now come and see here P0 is equals to D1 into KE minus G. Our D1, we were given the dividend 5.40. That one we were given at the start of the question. KE, I take the cost of equity, which is the return on equity, 15%. KE is the return on equity or the cost of equity, the same, 15%. That one we were given. You minus the growth rate, which is 0.06. Good. What becomes the price? 5.4. Divide that by what? 5.4 divided by what is 0.15 minus 0.06. 0.15 minus 0.06. I'm getting 0.09. Good. This becomes 5.4. Divide that by 0.09. I'm getting exactly 60. So the price is 60. So let's compare and tell the investor, you can go ahead or don't go ahead and buy, sell or hold. So let's go back to the question. We want to advise the customer or the investor. What was he asking? Finish. If you are still copying, we want to go back and advise the investor now. He was saying what? Let us go back. This is an investor who was holding the shares. So we are told, advise the investor who holds the shares whether to buy more or to sell. Listen, the current market price is how much? The current market price is 64.5. Note number 4 says the current market price is 64.5. But we have got the true value to be how much? From our calculation, the true value of the shares is 60. Here, the true value of the shares is 60. They are currently being sold in the market for 64. Tell him whether to buy more or to sell the one he has. what would you say? The true value is 60 as per our calculation. That is the intrinsic value. But in the market, the shares are being sold for 64. He holds some of them. Should he sell or should he buy more? Obvious, he should sell. Why? Because if he can sell, he will get more than what the value of the share is. If he buys, he's buying at 64 when the true value is 60. So he cannot buy. He only buys when the value is lower in the market than the true value. But now, the value in the market is higher than the true value. So for him to benefit, he has to sell before the price comes down in the market. The true value of the shares is 60, but he can sell them for 64. So he cannot buy more, because if he buys more, he's buying at 60, while the true value, he will be buying more at 64, while the true value is 60. There he is losing. So we can conclude now. Conclusion, andika now. Conclusion now. Sema hivi. Since the market price currently is 64, since the current market price is 64, while the true value of the share is 60, then the investor should sell, underline sell, should sell the shares he is holding. Should sell the shares he is holding. Should sell the shares is holding. Good. Okay? Okay. That is all. Maybe we can do one more. Let's do one more. We have done that question of 2021. We can do one more before we conclude. Let's do one more. Finish. I want us to project another one where we can do another one. So let me project another one. Let me project another one. If you are still copying, finish. Okay. Down there, I've given question 2. I want us to do question 2, Roman 1. Question 2, Roman 1. Question 2, Roman 1. Question 2, Roman 1. It's a question that came in May 2019. May 2019, question 2.1. Let me read it. It says, the management of Amani Limited is considering listing the shares at the Securities Exchange and intends to underwrite or undertake valuation of its shares. The following information is provided. Current earnings per share is 4 shillings. The firm has in issue 10 million shares with a 40% dividend payout. The firm has an equity capital of 200 million with a required rate of return of 18%. Required. Calculate the current theoretical value, that is the intrinsic value, of the firm's ordinary shares using the dividend growth method. Good. Let's again use which method? Dividend growth method. Okay. Now listen again. Do we know the G? No. Which method are they asking us to use to compute it? Is it the compounding method or is it the retention? What do you say? When you look at this question, we don't know the G, but you can advise or you can tell which method to use. Listen, note number 1, they are saying they are earning a dividend of, no, they have an earnings per share of 4 shillings. Okay? The dividend payout is 40%. Listen to this now. We know the formula. I am doing a question of May 2019, question 2, B1. 2019, question 2, B1. Listen, our formula for getting the PO is equals to DO into 1 plus G divided by KE minus G. Do I know the D note, the last dividend paid? We are not told. Listen carefully. We are not told. But is it possible to get it? Yes. Let me first explain. They have given me the earnings per share as how much? I think 4 shillings. Out of these 4 shillings, they have decided to pay out. There is a dividend payout ratio of what percentage? I think 60 or 40. 40%. Note number 2 says, the company has 10 million shares in issue with a 40% dividend payout. So, if the earnings per share is 4 and they have a dividend payout of 40%, so out of 4, they paid 40 as what? As dividend. So from this question, it was possible to get the dividend per share. Are you getting? Good. So what the question wanted you to start with is to calculate that DO, which is the dividend per share. Once you calculate the DO, then you also compute the G. G, we are using again the retention method. We know the payout ratio is 60%. So I can take, no, 40%, sorry. I can take 1 minus the payout ratio. That will give me the retention ratio. Then I multiply by the KE, no, the KE, which is the return on equity, and that will give me the G. So let's now first calculate. Put it this way. Copy that formula first. Then you come and see here, dividend per share equals to earnings per share times the payout ratio. Put down that formula. That dividend per share is given by earnings per share. You multiply that by the payout ratio. So our earnings per share, we are told, is 4 times payout ratio is 0.4, is 40%, that is 0.4. Our dividend per share is 1.6. Are you there? That's the dividend per share. Now we can get the G, which is growth rate, equals to R times KE. I don't have to keep repeating where you know them now. R is the retention ratio. You can even say here R equals to, we are not given the retention ratio, but it's 1 minus payout ratio. R is equals to 1 minus payout ratio. That's how we know we calculate it. I told you, if you know the payout ratio, then you can get the retention ratio. So our retention ratio is 1 minus payout ratio. So I take 1 minus 0.4. So that means our R is, I can even quote it so that you remember, R being the retention ratio equals to 0.6. retention ratio R. You can put it that way. Retention ratio R equals to 0.6. Now you know the retention ratio. Now you know now we can get the growth. Come and see, your growth is equals to R into KE. Our R is 0.6. What is KE? Let's go back to the question. We were given the cost of equity or the required rate of return by the equity holders as how much? What was the required rate of return? There is a note somewhere which we were told how much. Where is it? Note number 3. Number 3 said the firm's equity capital is 200 million with a minimum rate of return or required rate of return of 18%. Good. Now we know the required rate of return is 18%. That is the 0.18. Good. What becomes our growth rate? Let me calculate it now. What becomes the growth rate? So we are taking 0.6 times 0.18. I'm getting 0.108. 0.108, which is the same as 10.8%. That is our growth rate. That's our growth rate. Now we know the G. Now we know the D. It was not given. Now we can use the 2 to get the PO. We have said PO is equals to DO into 1 plus G divided by KE minus G. Let's feed in the data now. This will be our DO is what? Our DO is 1.6. We got the dividend per share as 1.6 into 1 plus 0.1, 0.108. That was our G, the growth rate. We divide that by KE, which was 0.18 minus G, 0.108. Good. Let's solve this now. This will be 1.6 times 1.108. Divide that by, what is 0.18? 0.18 minus 0.108. I'm getting a denominator of 0.072. So let me get the final answer now. This is 1.6 times 1.108. I divide whatever I get by 0.072. I'm getting 24.62. Good. That is the value per share. But let me go back and check what are they asking me to do. Let me go back. If you're through with the copying, are they asking us to advise or what? Let's go back and check. What are they asking us to do? Once you compute the value, go back and check whether you are asking to advise, blah, 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 whatever it is. So this question says, let's go back. The question says, calculate the theoretical value of the firm's ordinary shares. That is not one share. Of the firm's ordinary shares. How many shares were there? We are told calculate the current theoretical value of the firm's ordinary shares. So how many shares were there? Where is that note? Good. Note number 2. Note number 2 says the firm has in issue 10 million shares. Good. Now you know the value per share. Multiply that by the number. So we come and put down here value of shares. Value of all shares. Maybe we can put it that way. Value of all shares. value of all shares. This will be given by 24.62 times 10M. This will be 246.2 million. 246.2 million shillings. Good. That is it for now. Maybe for now we can even stop there. Pick it up from there next time, where we shall develop the topic. So for today we can stop there. Pick it up from there next time, where we shall now develop the topic. Okay. I hope you have managed to understand something from what we have already said. So if you have managed to understand something, please click the like button. I hope you have managed to understand something. Click that like button. 2, we have said if you have not subscribed, please subscribe. How? By clicking that subscription button down there. Subscribe so that you may be notified whenever we post new videos into the YouTube. 3, I said, tell your friends we have online classes for financial management of the intermediate, financial reporting of the intermediate level, advanced financial reporting of the advanced level. Then we also have financial accounting of the foundation level, and that of ATD1 and ATD2. Good. Then I said, if they can't join the live classes, they can buy what we called pre-recorded videos. That's what we said. They can buy the pre-recorded videos, where they can watch the videos at their own free time, at their own pace. And finally, I told you, you can reach me through 0722 658875. 0722 658875 for more information. Good. Otherwise, see you next time. Bye for now. See you next time. Bye for now.